All right, welcome to this webinar on multifamily passive investing. This is going to be what we call our blueprint series. We have a couple of weeks that are set aside that we're going to be doing every Wednesday on different things surrounding passive investing. And recently, I actually flew out to Houston, Texas, and was able to sit down with Ben and Feras, and we had a great conversation around this topic. And we just decided that as a group, we should share with our investors a little bit about passive investing and all the things that we've learned over the years. And I know, we both have invested passively, but we also deal with them and have a lot of passive investors that work with us. And so we're going to do that as well. I know many of you probably know each one of us, but many of you probably don't know who we are. And so I'll actually start off and give you a little bit of a background about myself and what I do here at our group. And then I'll turn it over to Ben or Feras and have them share a little bit about their group as well. And then we'll dive into this first topic here. This webinar is not a lot of fluff, so we're going to get right into the weeds of things and talk get really detailed about some stuff and spend about probably 45 minutes with you today and sharing this information. This first part is about setting up your multifamily passive investing strategy. So we're going to be talking a lot about some high level things, but then also getting down to some of the weeds with some stuff as well. So for those of you who don't know who I am, my name is Dan Handford. I'm one of the managing partners of a group called PassiveInvesting.com. We're a multifamily real estate private equity firm. We also have acquisitions inside of the self-storage space as well. So we have a self-storage fund, and we also have a real estate debt fund that we have for our investors too. My primary role in the group is from the investor relations side of things, and I also kind of oversee the overall strategic objectives of the company. Prior to getting into investing passively and starting the PassiveInvesting.com group with my other two partners, I actually owned a group of, and I still own them today. Actually, my wife and I own a group of orthopedic medical clinics. So right here in South Carolina, that's where I'm located, is in Columbia, South Carolina. So we have 4 locations with this orthopedic group. And of course, the money we were making off of that caused us to have a lot of tax issues. And so being able to invest in these types of high quality assets allowed us to have great depreciation to help us reduce our taxable liability. So that's a little bit about me. I'm married. I have a wife and 4 kids. I have a 10-year-old, a 9-year-old, 5-year-old, and a 3-year-old, 3 girls and a boy. My boy is my 9-year-old. And then one last thing I'll mention to you, just to kind of give you a little bit of insights about, why this topic is very, kind of dear to my heart. I'm passionate about it. And you'll see through the content through the next couple of weeks is that not only do I have a group that allows passive investors to invest passively, but my wife and I have invested in a little over 43, 44 different LP limited partnerships as a passive investor ourselves with about 15 different operators. So as we go through the next couple of weeks, I'm going to be sharing with you some of the things that I've learned, throughout this entire process of looking at vetting operators and looking at these different deals. And what are some things that you can look at if you're a busy professional and say, hey, this is a good deal, this is a bad deal, or this is a good operator, that's a bad operator, and a lot of different things in between. So looking forward to diving into that. And I'll go ahead and turn it over to you guys and let you do an introduction as well.
All right, Dan, thank you very much. Thank you for coming out here and, glad to be on here, right? And like you said, I think this is a topic that's near and dear, and I think not enough people talk about it, right? A lot of people talk about the concept of passive investing, right? It's a thing that people are interested in, but I think not enough people talk about the good and the bad. So kind of, collectively, I'm looking forward to just really deep diving in that and talking about the good parts and the parts that suck about it as well, right? Nothing's perfect, and really giving people, our philosophy really is an educated investor is a good investor. And so that said, Feras Moussa, managing partner at Disrupt Equity, started it with Ben, my partner, who's also on this call. We are a real estate firm that primarily invests throughout Texas and Georgia. There are a few other markets that we are interested in, one of them being Florida, right? Dan, in your backyard, and kind of where you've been investing as well, and, North Carolina. And, we are vertically integrated. So we do have kind of our own management company and a few other auxiliary businesses, but primarily we're cash flow investors, right? We look for opportunities that can help us basically, acquire a property, push up that revenue, and then from there, cash flow for our investors. So I've done multiple deals full cycle and looking forward to continue to do more. And so with that said, Dan, we, for those that are attending, we are very candid people. I know you are too, Dan. I think that's what's going to make this kind of a fun topic, right? Is just really laying the groundwork, let people talk about the things that they want to really ask, right? Not enough people get to ask those opportunities. And so, with that said, happy to kind of deep dive on anything.
Well, and one thing I'll tie in here too is that we have no agenda behind this webinar series other than sharing with you about what our purpose is and what the things that we do with our different groups. And, if you decide, hey, I want to follow them more, great. If you want to invest with each one of us somehow, you can certainly do that as well. But we don't have any agenda of trying to like sell you something or do anything like that. So put your guard down. Our guard is down. As a matter of fact, this presentation today, none of us really prepared for. So we have some questions in front of us.
By design.
And it's done by design like that. I mean, our team behind us, each one of our groups put this thing together for us, knowing that we could talk on these different topics very well because we have experience with them. And I think you'll see that as we go through this material, that'll be very eye-opening for you. So maybe Ben prepared a little bit. Maybe he read the topics ahead of time. I don't know.
Ben's
I was going to say, we all are passive investors too, right? Not only do we invest in other people's projects, but we also invest in our own projects as well. So, I think that we're in a very advantageous position to, go through this topic. We're not looking at it only through the lens of an active operator who has never invested in anybody else's projects, right? We all invest for different reasons. A lot of it's probably tax incentives as well, right? Which we can kind of get in here in a minute. But, one thing I wanted to kind of stress to people, right, is, find out your box. That's probably the most important thing, right? What is your box? What do you want to invest in? Some people want to invest in Class A and primary markets. Some people want to invest in new development deals, right? Some people want to do value add, flips, right? That type of stuff. And I think people need to understand from, their own perspective and their own risk tolerance, what they want to get into. And then that'll also help kind of guide their path as well. So that's going to be my first tip, of the series is, find out what you're comfortable investing in, and then go and find the operator that's doing that, right? Or the operators.
And that way you can spend the life that you want to live and be at the beach like Feras is right now. I mean, look at that beautiful beach.
I know, man.
No, actually, I will add, I literally flew in last night, got in like 9:30 from the other side of the planet to be here with everybody. So, it helps kind of enable those kinds of things.
Let me see if I can do it here. Let's see. Oh, there we go. There you go. A little beach scene going on.
Hey, whoa. Somebody's got to be working here, guys.
All right. A little bit of fun. Let's dive into this first topic here. The first kind of a topic that we want to cover here is should somebody who's on the webinar today, should they be considering the option of being a passive investor or an active investor? That's kind of the question at hand here. So I'll turn it over to you guys first. Let you guys kind of opine on this first. I'll kind of fill in some of the gaps as well.
I'll answer that one, right? So, for those that don't know, my background software, worked at Microsoft, had extra cash I was looking to invest, right? And, found out about real estate, did a bunch of single families, realized it doesn't scale, found out about syndication. And, initially I was looking to just invest my money, right? And I invested with multiple operators to kind of see the good, the bad, and the ugly, right? See who I liked, who I didn't like. And, and it's not to say there's a good and a bad operator, right? Sometimes it's just formats, right? Some operators communicate more than a person might want or less than they want. And so really was able to do that. And from that, what I realized is you actually learn a lot by investing passively, right? I think a lot of people think it's one or the other. And I actually make the argument of why not both, right? You start off with one, you learn all the pieces of it, right? And Dan, as well as I do, investors have a lot of different questions throughout the transaction, right? And so being that passive investor, you learn, how does an operator present that opportunity, right? How did you feel just wiring that money? Most people don't wire big chunks of money for anything besides a house, right? So how did that operator present that? How did you go about that? Does that operator have a team behind them or not, right? And how did the opportunity itself go as expected, right? Did they communicate monthly, weekly, yearly, quarterly, right? And does that match what you're looking for? So I think you really learn a lot as a passive investor. And I think that's the people should start off as a passive investor, but then ultimately ask themselves, what are they looking to do, right? Being an active investor is being active, guys. This business, as nice as it looks like it's easy, it's really not, right? There's a lot of moving pieces. It's a full-time commitment for us, right? And, not only us, but we have entire teams. And if a person is looking to make this their full-time job, by all means, active is really the way to go, right? But, I think most investors really enjoy being passive, sitting back, getting a paycheck in the mail, and just kind of being at the beach that I wish I was back at.
And I wanted to add to that, right? Because I think he first really touched on a point that I always kind of drive home with people, right? You really needed to just decide, do you have really the time to take on a second career? because being an active investor, buying up apartments or self-storage or whatever it might be, that's another job. Right. And so if you don't physically don't have the time, I always use the example of a surgeon that works 80 hours a week, right? That person can't go and effectively scale up a syndication or a commercial real estate firm unless they take away from their surgeon duties, right? Being a doctor, and because they just physically don't have enough time in the week. So I think that's the first question that people need to answer is, do you physically have the time to have either a second career, or do you even really want a second career? If you don't, then you probably should explore passive investing a little bit more, right? And maybe things will change in the future, right? Where you're working a little bit less, maybe the kids are off to college, maybe you want to start exploring being active. At that point, you'll have some more experience, right? And then you can maybe go down that path. So just something to add.
And I'll second what Feras said is that, my background is in this group for our group passiveinvesting.com. I started out as a passive investor, right? Before we started the group, and got my feet wet and kind of learned the business a little bit. Then I kind of hired a mentor and then started going down that path. And so it definitely is not just one of those things that you can just, I don't personally believe you can hold down a normal corporate 9-to-5 job and be able to run this kind of a syndication effectively, efficiently, and grow it the way you need to grow it and protect your investors' money. And actually next week, our topic next week, and the part 2 of this series on the multifamily passive investing, is going to be about red flags that you should be looking for before you invest in a deal. And one of those red flags is that the operator must be full-time in the business. You should never invest with a group that is not dedicated full-time to watching your investment. And that's a very important thing. And I know there's a lot of people that we get as passive investors with our group, that they find out about us because we have a group, as many of you probably already know, called the Multifamily Investor Nation. And we do weekly webinars teaching people how to become an active investor. Well, we get a lot of people that are online and they're searching, how to raise money or how to financing for multifamily or whatever, and they figure out that it's actually a lot of work, right? It's not a walk in the park, And I will say that nothing that we do is very hard in and of itself. But it's the complexity of how many of these easy tasks that we have to do and keep track of, and timelines. And, it just before we even jumped on here, I was talking to Ben and Feras and saying, hey, we're getting so busy right now that we actually have to hire somebody just to keep track of the timeline of the transactions that are occurring, right? Because there's dispositions, there's acquisitions, there's you're touring properties. There's just so many different moving parts. And outside of our property management side of our business, we don't actually do in-house property management. I know you guys do over there at Disrupt, but with our non-property management team, we have about 19 people now that are working for us. And between now and the end of the year, we're probably going to have another 5 or 6 more people hired on in various positions to be able to maintain the growth that we have and be able to protect the investments that we have from our investors. And that goes back to the team aspect of what Feras was talking about earlier as well, is you want to make sure that you can have this team, but you have to ask yourself, do you want do you want another job, or you're gonna have to manage other people? Or are you at the point in your life where you're like, okay, I've worked this job, I really want to get out, I want to enjoy the kind of retirement years, I want to enjoy, being able to get out and do what I want to do. And I know some people that are invested with us that are in their 30s and 40s, and they're already retired because they've been able to invest passively, replace their income, and now they're living the life that they want to live, right? And so there's lots of different options out here for you. And that's kind of, the decisions that you have to make, or the main decision you have to make is do I just want to be a passive investor, invest and take those cash flows and then continue to roll them every 3 to 5 years into different investments and just grow my wealth over time? Or do I want to be that active investor that spends my time, 40, 50, 60 hours a week? And I know sometimes we're working more than that every week, depending on the week and how many closings we have and different personnel things and stuff like that. But it truly is a business. And one of the things that we're actually doing right now as a group is we're actually in the process of writing a book. We started on it earlier this year in January, and we're writing a book about that topic itself, about how apartment syndication is a business, and you have to treat it like a business when you start to bring on other people's money to be able to protect their investment. It won't be out anytime soon. It'll probably be Q1, maybe Q2 of next year before it's ready or whatever. But that's something that, as a big topic, that is for me a really big red flag, is when people try to do this kind of as a side hobby in the nights and weekends. It just doesn't work.
Yeah, and it's just about the lifestyle people want, right? I think both us and you, Dan, I mean, we love building businesses, right? That is almost my retirement, right? Yes, we have passive income, but building businesses is fun, right? That's what we enjoy. Not everybody loves that, right? And so being active, you have to ask yourself, is that the business you want to be in? But one other thing we kind of glossed over that I think is kind of important is, what does active mean, right? For us, we are raising money. We have other people's money we're responsible for, right? We are the stewards of their money. A lot of people, active means they're going to go off and buy their own smaller complex, but then they got to kind of understand not only they're signing up for a job, but also, are they going to get the economies of scale they want, right? Yes, some, higher net worth people can afford to go take down a 200 unit property, right? But if you're looking at doing that 30, 40, 50 unit yourself, ask yourself, does that actually give me the economies of scale? Because again, in that world, you're not really getting full dedicated on-site staff, right? Neither of us will buy a property that cannot support full-time staff that, that work at the property night and day. And so as active means you're going to be really active in one model, versus if you have the money to go buy your own, yeah, it can be a little bit more cruise control than the smaller deal, but just kind of, again, understand that responsibility you're taking on, right? If you're taking on a smaller deal.
Yeah, and even if you're taking on a smaller deal, you might think, oh, I can still be passive because I'm going to buy the deal, I'm going to put property management in there. But guess what? Both of our groups have a person that's dedicated to asset management, which is basically managing the manager. So yeah, it's not passive. There's issues that occur that those property management companies have to reach out to you and you have to make decisions on. So lots of different decisions that have to be made there for sure. Let's move on to the next topic here, which is about the multifamily economic cycle and where we are right now. And we can kind of cover the topic of, should this cause any concern for the passive investor?
All right, let me pull out the crystal ball.
Yeah,
Take a quick look.
I think, you look back to January and February 2020, right? And I think even then, coronavirus really wasn't even a thing. It was something that was happening in China, right? And then within 6 weeks, we had a lockdown. So I think, kind of determining what's going to happen in the future is tough. But, I always tell people, hey, the best time to invest in real estate is right now. Don't try to time the market where you're going to wait for some kind of a downturn where you're going to get a better deal or you think you're going to get better returns as a passive investor. Right now is when you should be getting in, right? I always tell people too, if they're going to be passive investing, they really need to be looking at the tax benefits of commercial real estates too, right? Because the tax code, tax laws, there's been a lot of stuff in the news, about what this administration may or may not do. I think some stuff's maybe gotten shot down. So maybe it's not as bad as we think it's going to be, because politicians also own commercial real estate as well. But that's something to think about as well, right? If you're waiting for the perfect time and then boom, your capital gains goes from 25% to 50% or whatever it might be, or they scrap 1031 exchanges, you might get aced out of some of the benefits of commercial real estate. Right.
And I'll say this to kind of Ben's point. I think timing the market is hard, whether you're in the stock market or the real estate market, right? It's about going in, make sure you've mitigated risk, right? Don't go in, 90% leveraged on every deal that you can, right? And hope it all works out, because, it's very risk, right? It's for an investor, as a passive investor, you need to ask yourself, am I going in? What are my risk adjusted returns, right? Some deals look fantastic on paper, but they carry high risk, right? If we're doing a C- deep value add deal, that carries a lot more risk than a newer deal in a better location, right? People need to understand risk adjusted returns, not just returns. And, with that, time fixes a lot of problems in real estate. It really does, right? And that's the beautiful thing with real estate, is that given enough time, a lot of things get resolved. And so getting comfortable and understanding that, right, it helps people kind of get into it. And, for us, right now it's a hot market, right? It's easy to, we're going full cycle. There's deals that we were planning to hold for 7 years that we're selling 2 years later. Many of those, right? Again, it's that time aspect. Well, hey, we planned for that, but we're going to go shorter, and maybe the inverse will happen. You never know. And I think for this cycle right now, it's obvious, as we all know, it's a hot market. I think there's still a tremendous amount of pent up money in the market that is still going to look into investing in real estate. And as much as we all think cap rates will maybe worsen. I think they're going to continue to compress because ultimately there's just so much money in the market, and things like CDs and savings accounts, they're piss poor, right? I was in Dubai early this week talking to, a cousin that has a very, very large fund, and he was kind of talking about the same thing, which is ultimately yield is hard to find right now, right? And in some of these things where there's a half a point to a point in returns, well, guess what? In real estate, even if you're buying at a 4 cap or a 3 cap, that's still 3x, 4x, 5x, some of these other options, right? And so I think real estate is still a very attractive asset class. And I honestly think it's going to continue with what we've seen. Maybe not as crazy in terms of the past 6 months. It's just been, you're seeing 10-point, compressions each week, right? In some aspects. But I think there's still a tremendous amount of money that is going to look to get placed into real estate.
If we would have had this conversation 2-3 years ago, we would be having the same discussion, because we would have been saying the market is just so hot right now. I mean, 5.5%, 6% cap rates are just crazy, and then, we look back now, and there's deals that we bought just a year ago that we bought for 57 million, and we're now getting offers on it for 72, 73 million just a year later, which is just nuts. Right. But I would definitely say that I agree that the cap rates are going to continue to compress. Again, crystal ball, hypothetical, speculation zone, right? I mean, we don't know for sure, but there's nothing really in the market right now that is pointing to something that is going to cause some sort of a boom or some sort of a crash or some sort of like major, decompression of the cap rates, which is going to cause the valuations to just plummet. Right. And here's the thing. Let's just say worst case scenario, something like that does happen. Well, like Feras said, time heals a lot of wounds in real estate, right? So as long as you have underwritten the deal properly, you have ample and operating reserves, and you can maintain that asset through any type of downturn. Listen, if you go back 100 years, in the last 100 years, every single one of the recessions that we've had have not lasted more than 18 months. Right. And so if you can write out at least 18 months of some sort of economic recession on the other end, things are going to get better. It's just this is how history has presented itself. And I had a conversation just the other day with an investor who asked me about the inflation. Like right now, inflation's at like 5.4%, which is just, again, crazy. Right. Well, he was trying to, base the 5.4% inflation on a kind of sub 5% cap rate, and says, hey, it just doesn't make any sense. But there's two different things. You can't correlate cap rates with, inflation at all. Right. And actually the inflation going up or being 5.4% helps real estate quite a bit.
Yeah.
Because we have more value in the property, because we can actually now have our residents are making more money, so we can charge more. And we also can charge more when I don't really want this to happen from an economic standpoint, because I don't think it makes sense. But, raising minimum wage to $15 an hour across the board, I don't want that to happen. At least half of me doesn't. The other half of me does, because I know it'll allow us to charge more for our resident from our properties, and our values of the properties will go up.
Yeah, and I think speaking of inflation, people need to realize, right? Inflation does not mean values of real estate will go down, right? For anyone that knows about real estate, it's valued based on a cap rate. Cap rate is equal to the NOI over the valuation. And so if inflation happens, right, that means your NOI is probably going up, right? You are extracting more revenue per person over time, right? I mean, just the inflation number itself, if it's going up 5%, in 2 years from now, I've extracted 5% more revenue, right? Well, my NOI has changed. My expenses might have changed minimally, right? But not relative to inflation. So I've actually increased the value if cap rates stayed the same. And people tend to, look at inflation and on it. It's exactly what you said, Dan. Being a consumer, I don't really want inflation to go up. But being a real estate investor, I'm like, I kind of like it, but I want it to happen after I buy more real estate is the problem. So it's kind of a little bit of a tit for tat.
Well, inflation is not going to go away, right? So there's got to be, you got to buy now. That's kind of what Ben was saying. Now is the best time to buy. Yesterday is too late, right? And just like if we can fast forward right today to 2023 or 2024, you're going to probably be sitting there back then in the future and going, man, I wish I would have invested earlier. Right. And because I know operators that just did not buy anything the last 2 or 3 years because they thought things were just overpriced. And guess what? They're now calling me up going, man, I just wish I didn't sit still for so long. I wish I was able to ride the wave that you're doing right now.
Yeah.
And I
then
think
like
the
you
other
said,
thing, go ahead, man.
no, I was gonna say life is easy in hindsight, right? And it's just about look for next week and the following week's webinar is about red flags and how to secure your investment. But it's about, I mean, there is risk in anything you do. Real estate is also one of them, but it's about being smart risk. And again, to what you said, Dan, I mean, you're right. Recessions have only been 18 months. And so if you can kind of grind it out past that, right? And then you work your way past, kind of upwards from there. And the sooner the better. And, given enough time, I do wholeheartedly believe real estate will be okay, especially multifamily real estate, right? This Fed has kind of shown us like, hey, that's actually really important and we will support it as a government. So.
Yeah, and I was just gonna say, I mean, you're seeing real rent growth, right? And whereas maybe in the past, if cap rates were compressing, it was for no other reason other than multifamily was this high asset class, right? Now you have real rent growth that goes along with that, and you've got a ton more money that's going into it. And so, yeah, I mean, that's where you see this asset growth. So I'd say right now, you at least have the fundamentals even seem a little bit better, right? Also, we got rid of the eviction moratorium. So you can churn the tenant base as needed, right? And get higher paying tenants in some of these in workforce housing properties. So, I'd say right now is a great time. Whereas fundamentally, maybe even a year ago, it would have been even more challenging. So, that's where you're seeing a lot of demand. And there's people that have, were in hospitality and retail and office that are now gravitating to multifamily because they see the fundamentals are just spectacular. So
let's shift to this next topic here, which is about setting your investment criteria. And I'll take this one to get us started and let you guys kind of take over from there. But setting the investment criteria as a passive investor. And, we kind of touched on this a little bit in the introduction here. I think Ben kind of touched on this just a little bit, but you have to, as a passive investor, determine which asset class and which markets you want to be in based on your risk profile, right? And what you really want to see in your portfolio. It's obviously when you talk about a portfolio, you always try to think about, hey, let's have a little bit of the kind of higher risk investments, have some of the more moderate risk investments, and also have some good low risk investments as well. And those all exist within multifamily real estate. And what we see is that if you look at the different asset classes, so Class A has the lowest risk. Class B kind of has this kind of middle of the road, kind of moderate risk. And then the Class C and the D have the highest risk, right? Now, if you look at the returns, they also match that, right? So if you want the highest returns, you want to go into the Class C and Class D assets. Again, higher risk. So is there a potential you could, not make as much or lose some money? Yes, there is. There's a potential for that for all of these different assets, right? But then but the highest risk is in that Class C and D. And then you have the Class B assets, which are kind of that middle of the road, where you have that kind of moderate return. And then you have the Class A's, which have low risk, low return, but they have consistent cash flows, right? And so there's this kind of balance that you have to think about of these four different of these, I guess there are four asset classes because it's A, B, C, D, but kind of the three categories, which one do you want to be in? And I think if we were to talk to anybody that was on here right now, you'd probably say, well, I don't want to be in any one of them solely, right? And so you have to figure out, what operators acquire these various types of asset classes and maybe invest in each one of these things and determine for yourself where you actually want to be as a passive investor and diversify not only with the asset class, but with the markets that they're where you're investing in as well, because you don't want to be overly weighted in just one market. You want to be able to have that diversification and that kind of a blended portfolio approach, if you will, because you're basically creating your own fund, if you will, because you've seen a lot of these kind of multifamily funds that have come out where they're raising $50 to $100 million, something like that, to acquire a couple $100 million worth of assets with that fund. Well, you're basically doing that yourself, but you get to kind of cherry pick which assets and which operators and which classes you actually want to have inside of your own kind of family portfolio fund that you're putting together for yourself, so you can actually normalize and blend out your entire return profile.
No, absolutely. I mean, you hit it on the head.
And maybe one thing to add to understand risk adjusted and the level of rate change between them, right? Because the problem we're seeing is C, B cap rates have gotten so tight and narrow that yes, on paper, I can maybe make a tiny bit more money on C, but it's also a lot less risky to go with a B And so really risk adjusted, I mean, 9 times out of 10, the B makes more sense. I think as passive investors, they got to be conscious of that, right? It's not just about looking at IRRs and, blanket saying, okay, well, I'm going to get this, I'm going to get a 13 here and I'm going to get a 12 there. So the 13 is the right answer, right? It's really do a little bit as a passive investor. You do need to do your homework, right? Don't believe what I'm saying or what Ben's saying, what Dan's saying, right? Do some of your own due diligence, do some of your own homework, right? Let our track record speak for us, but really understand the area, the deal you're getting into, and just be comfortable with that level of risk, right? There is risk in anything you do, whether it's a stock market or real estate or something else. And, again, understand, I think not enough people understand what risk adjusted really means. And so that's kind of maybe my 2 cents there.
And just to kind of add to what they said, I mean, ultimately, I agree with everything. It's, the one thing that people need to also realize too is that, are they looking for cash flow day one? Or are you looking for maybe a bigger pop at the end, right? The other asset class that we could kind of, add into the mix is development as well, right? But development, right, comes with a level of risk itself, right? Things could happen. Lumber could go up as we saw this year, but typically there's a huge pop at the end. Right. So as a potential passive investor, you need to realize, hey, am I going to subside on this cash flow? And if so, maybe go to something that's a little bit more consistent from day one versus a new development deal, or even, we've done big value add, almost flips, right? Where there's, 12, 18 months where there's no cash flow, right? But then you refinance out or you sell the asset for a big pop at the end. And some people love that because you're creating a ton of value. Right. But there's not going to be any cash flow up front. So, as a passive investor, when you're looking at what you want to diversify into and invest in, you can also add those as well. And, what do you want to do? And what do you need to kind of live on?
Well, and that also goes into kind of what we're seeing over the last couple of years, and our group does it as well, where you have 2 different share classes within the same investment as well. And so you have an opportunity to diversify your risk profile within the same investment, because typically what you'll see with these dual tier structures is there'll be a class A share that'll have some sort of like preferred equity slice where you are getting preferred treatment with your equity, but you're giving up the potential for upside, but you get a higher cash flow during the hold period. And so for some of you that are saying, hey, well, maybe I want more cash flow, well, invest in some sort of a class A opportunity, class A share opportunity within an investment, which will allow you to have that preferential treatment in the capital stack. And then for those of you who maybe say, hey, I don't really need the cash flow right now, or not very much, maybe a little bit's fine, and then I'll just wait for the big pop at the end, then that's what that class B share is for those that really want to be in that kind of growth-oriented mindset. And again, Class A is less riskier than Class B within this, even no matter what asset you're in, it's always going to be that way as long as it's structured where that's a preferred equity piece. Now, don't get me wrong, there's different types of ways to structure deals that are 2 different tiers, and they have nothing to do with preferred equity. So make sure you're reading your documents. That's something that we're actually going to be talking about, I believe next week. Actually, we're going to be talking about on the next part of this, part 2, how to efficiently review and analyze multifamily offering documents as a passive investor. So we're going to be diving into that some next week and going through some of that. But just thinking about that, I don't want to go too much into that right now because we're going to be talking about that in more detail next week. But it's good to kind of know that there's things that you can do as a passive investor to easily analyze some of these documents to know what you are actually investing in as well.
No, I love that too. Yeah, and that's something that's grown in popularity over the last couple of years too, right? Where you're able to blend that risk just within that one investment as well. So, and these are questions that people need to be asking themselves before they put $1 into anybody's deal. Is what are you trying to get out of this, right? And then chart the path to get there. That's the most important thing to think about.
So the last topic we have for today is how to find the right deals and competent sponsors. And this one's going to be easy. They're on your screen right now.
I know. They're in my mind. You hop on this webinar and you hear them and kind of, and I think, as much as we're joking, it is kind of part of the truth, right? Are the operators you're talking about willing to share information? Are they available or not available, right? I know all 3 of us make ourselves very available to investors, right? It's an important part of the business, right? Operations is critical, but then also getting investors information, sharing what's going on, and being there to answer questions is just as important. I think, getting out and just, it's all, I would say, recommendations and word of mouth, people. So it's not that hard. Go get to know people, ask to talk to their investors, right? Get to know how they performed or not, right? And what does the track record say? And so that's maybe, those are, I'd say, the kind of the big thing.
I'd say referrals definitely first and foremost, right? I mean, what has been the experience of certain people with certain operators? That's the most important one. But I mean, luckily with the, with the internet and everything that kind of goes along with it, podcasts, there's plenty of opportunity for people to find operators that maybe they can connect with, right? And I'd always tell people, have that call. I mean, it's surprising to me. We'll get leads and they'll be like, yeah, no phone call needed. I'm ready to, to throw money at you. And you're just like, nah, I'd much rather at least, we get to know each other a little bit, right? Ask some questions, find out what their goals are, right? Because you might going back to our earlier topic, you might find out that, hey, they need cash flow day one and you've got a new development project coming up and it's not a good fit, right? So it's important to actually go and talk to the operators too and find out what their business model is and what they're looking for, but yeah, I mean, we've met a lot of people through webinars and podcasts like what we're doing right now.
And maybe one other thing, Dan, you kind of alluded to it. Also, see if they have a team, right? I really think that's important. Yeah. This business is too important, too big, and too sensitive, right? It's people's hard-earned money, right? Their life savings. I mean, I remember there's a deal that we sold where, the woman had put in a significant part of her savings and did well. And she was kind of crying, saying, hey, I'm going to retire 10 years earlier, right? That's a huge deal. The opposite can happen too. And so be conscious of that and just make sure that the investment you are making is with a team and not just a person with a side hustle, right? Be aware of that. There's nothing wrong with the person with a side hustle, but again, it goes back to risk adjusted. It's a different level of risk. If you're okay with that, by all means, right? So.
Well, and I think a lot of times we get caught up in, thinking about, oh, do I need to do background checks on these sponsors, like actual background checks? And I'll tell you that most criminals or most people that are doing things the right way, most of them in the beginning don't have a background to check, right? That's usually pretty clean. Like you think about Bernie Madoff, right? If you would have done a background check on him, he'd have come out clean, right? And so a lot of it has to do with reputation and talking to other people. And that call me up, call Ben up and Feras up and say, hey, what do you think about this group over here? Right? Yep. What do you know about them? Because this is a very small industry when it comes to this multifamily kind of syndication space. And we all kind of have an idea as to these different groups that are out there and how they work. And it's good to have that kind of recommendation. And that's one of the things that we do for our investors. We actually have a printed physical newsletter that we send out to our investors every month. And we only send it out to our investors, but inside of that newsletter a couple of weeks ago or a couple of months ago, I wrote an article about what I do with my own portfolio, where I think I told you guys earlier on, I have 15 different operators that I've invested with, my wife and I, with our own portfolio personally. And people were asking me, well, can you make recommendations? And I was like, sure. There are, of those 15 people, can I recommend all of them? No, I can't. Not because they're not because they're bad or that, they've done something wrong, but it's just too early in the process for me to be able to make a recommendation. But there is a handful of those 15 people that I can certainly say, hey, these are some people that I would highly recommend you look at. Now, obviously, you got to do your own due diligence on it. I don't want you to invest in a deal and it goes south and you come back and look at us and say, hey, you recommended this investment and I lost money, right? But we do try to make recommendations to our investors and say, hey, we know you're not going to just invest with us, right? As a matter of fact, we think it's smart to diversify, right? Outside of just our group. So if you want to invest in these couple of the different groups, and sure, I'll make some recommendations that's in my own portfolio that I think have a great reputation that can, still, watch out for your investment. And then next week, we're actually going to dive into some more details around this topic and get into some of the weeds of, these red flags. We talked about them earlier about some of the red flags for passive investing and what you should look for in a deal, but not only in a deal, but the sponsor behind the deal. And so we're going to go into some of those red flags and share with you some things that, whenever I'm personally, my wife and I are looking at a deal, if these red flags are present, we close it up and say, we're not investing. And so we're not talking about yellow flags that just make you go, wonder if I should, wonder if I shouldn't. It's like, no, if these red flags are present, stop wasting your time, close up the PPM and move on to the next deal, right? That's the kind of thing we're going to be talking about next week in this kind of part 2 of this series. And so I'm looking forward to next week, because next week is going to be a lot different, right? This is kind of more high level stuff. But next week we're going to get into something a little bit deeper than that. And so make sure you register for next week's webinar. And it's going to be on that multifamily underwriting through the eyes of a passive investor. Let me go through the topics here real quick, and then I'll open it. We'll kind of wrap it up with some final thoughts here. First topic we're going to talk about is how to efficiently review and analyze multifamily offering docs, what the red flags are for looking for what you should look for in a deal, and then discussing common deal structures for real estate syndication, thoughts on the advantages and disadvantages of underwriting refinances into projections, and how to know you are investing with a competent operator. And of course, we always add a lot of different things in between there. There might be a little bit of overlap, but it's going to be some pretty action-packed stuff next week. We might not be able to fit it in just 45 minutes. We might have to go to an hour, but we're going to do our best to kind of keep it around that 45 minutes to an hour time slot. But we're looking forward to that. And I want to open it up to you, Ben and Feras, if you have any closing thoughts before we wrap it up for today.
I have one thought, right? And first and foremost, I wish I had this information when I started off in 2013,
For sure,
man, because this is gold, folks. I think people take a lot of this for granted, that 10 years ago, this cost you tens of thousands of dollars to learn a lot of the stuff that we're just giving away, because that's the type of folks that we are, right? We're very transparent. But the one thing that I've learned is, and Dan can probably attest to this too, right? If you get so many passive investments, sometimes that turns into a little bit of a job itself too, keeping up with all of it, right? Managing that portfolio of passive investments, getting in those K1s, right? Whatever it might be. So just take that into consideration. Use some folks might be listening in, they've got hundreds, maybe millions of dollars to invest, right? And you're going to say, I'm going to get into 100 deals. Well, guess what? That's 100 K1s you got to get. It's 100 operators that you might have to ask questions to. That's 100 deals that you're going to have to continue to review, right? And so take that into consideration when you're defining what you want to do and what your path is going to be. That'd be my parting piece of advice for today's webinar.
Yeah, and maybe to add to it too, right? We kind of alluded to it just now, but the best referral, not only as an investor, but even other operators, right? And there's a reason we're all doing this together, right? We in terms of just confidence in the information, confidence in the other person, and knowing people are doing it the right way. There's a lot of people that don't do it the right way. Get to know your operators, get to know their investors, and go get yourself educated, right? We are firm believers. I know Ben and I know Dan as well, is educated investors are the best investors, right? Because not every deal is perfect. Things happen, right? People that understand how things happen and why they happen and the solutions for them are the people that we ultimately want to invest, right? Those are the right people with an investment mindset that can take on that level of responsibility and risk. So,
and then my final kind of thought I would have here is kind of going back to the very first question we posed at the beginning of this is, you determining whether or not you want to be a passive or an active investor. And, even as a passive investor, one of the biggest things I would suggest is learning the underwriting, because it'll help you when you're analyzing a deal from a passive investor's perspective. And then as an active investor, never stop learning. We're always constantly learning and going to conferences and being educated. And, you want to always be in that mode of education and continuing to kind of fill your mind with ideas on how you can improve your processes and improve your systems and grow your team and still be able to watch over the investments that you have. We had an investor that called me yesterday. He's getting ready to invest in one of our most recent offerings that we have. And he asked me, he said, I'm a little concerned about your growth. He said, you guys have had a tremendous amount of growth over the last several years. And I just wanted to understand your strategy of what you're doing to make sure that you can continue to protect my investment if I invest with you, because I've seen groups try to get fast too quickly and it ends up not working out, or the partners kind of fall out and there's, kind of the investor kind of stuck there. Right. And I had to reassure him that, listen, we're in this for the long haul. We're not doing this for, a couple of deals and that's it. We're not doing this for 5 years. This is a long-term, multi-decade business that we have created that will help us grow our own wealth as well as our family's wealth for many, many generations. And, what we're doing is we're building out a team to support the growth that we have. So we take the asset management fees that we earn and we use that to grow our team and hire more people. Right. And so we're going to continue to do that as we grow. And as you are thinking about if you want to go into the active side, That's what you should do as well. That's how you should think about setting up your syndication businesses. How can I grow my team to a point where I can make sure that the growth that we have will allow us to support the investors and the investments that they have put in with us and they have trusted with us? Because there's both of our groups have a lot of money from our investors, a lot of equity that they've entrusted with us. And guess what? We all three sleep really well at night because we know the types of investments we're getting our investors in. We know and trust in our team that we put behind it to support it. And we can continue to grow even faster as we go over the next couple of years. So thank you guys so much for joining us here for this webinar. Look forward to seeing you guys next week on part 2. And we'll be sending out an email with this recording as well as the information about part 2. We'll look forward to having you on. Thank you, Ben. Thank you, Feras. And we'll see you guys next week.
Thank you, Dan. Look forward to seeing you. Thanks, everyone.